Good morning, viewers, and thank you for tuning in to India's 2016 budget update by Excel Funds. We found the budget to be a very positive budget. It was a very growth-orientated budget. A lot of spend towards infrastructure, so a big improvement. I think it's very important because the BJP party has noticed that there's been a lack of infrastructure spending over this past decade, and a lot of the savings from the lower oil prices here today are being redirected towards infrastructure and manufacturing. There's lots of fiscal consolidation, meaning that we see the fiscal deficit slowly being reduced over the next 3 years. So this past year was 4.1%. They're projecting 3.9%, falling to 3.5%, falling to 3% by the year 2018. The government's predicting a current account deficit of less than 1.3%. A lot of this lower oil price is reducing the current account deficit, and we're seeing that it's possible even to have a flat current account in a matter of a couple of years' time. I think it's very important that they're merging the foreign institutional and foreign direct investment limits. So they're making it for the financial institutions, they're raising those limits from 49% to 74%. So very positive, and that we'll see more foreign investors and the opening up of some of these Indian companies. The government's talking about selling off some state enterprises in a year's time. So again, that will also reduce that fiscal deficit. So definitely moving in the right direction. There's been lots of talk in that they're going to be providing a lot of incentives for gold and financial assets to be deposited with the India government and to have an interest return on those gold assets. At the same time, they'll be able to lend those gold assets out. So a new program, very creative program. A lot of talk about the goods and services tax to be implemented in April 2016. So again, this will reduce some of the complications between the state taxes and the government taxes, and really make it logistically easier to move goods across the country. There's a lot of talk about the corporate tax being moved from 30% down to 25% in 4 years' time. So again, that's very positive for Indian equities and for the Indian stock market. They're talking about monetary policy in that they're trying to cap inflation at 6% with a 4% target, and they've been talking about a 5% target at the end of this year. I think one of the biggest factors that came out of the budget that surprised me was the GDP growth, in that they're predicting GDP growth from anywhere from 8% to 8.5% in fiscal 2016, and that's the year that begins on April 1st. So really, India is the fastest growing economy in the world, and it's by far outpacing China. We'll see a lot of new roads and railways as a result of this budget. Spending on the railways is going to be up 20%, so we're going to see lots more track, and really what we're doing is connecting all the smaller cities across India and really creating a better hub for manufacturing. This will be able to get the goods out to port and be exported to the world. At the end of the day, I mean, it is a budget where they are slowly reducing the government and empowering the states to promote economic growth for the country of India. I think also we're going to see India will have a rating upgrade in this year's sometime in the next year or so, and I think that's very important for the India bond market as well. The India bond market looks to be very strong in that we see a possible rate cut coming in April, and then another rate cut later in the year. So again, with rate cuts and lower inflation, the bonds here today look very cheap and very attractive, and therefore we think that these bonds can have even a double-digit return on top of the 7 3/4 interest that you're receiving here today. So both the bonds and the equities look very attractive. So investors should stay tuned. They should have an allocation to Indian equities because really India is the only country in the world today that is reaccelerating. So thank you.